It's a function of saying, I'm China or Vietnam or any trade surplus creditor nation. All they have to say is this: I no longer want to park my savings in dollars and US debt. I prefer to own gold, or in some cases in platinum and silver. I want hard assets. And I want to hold these assets that are outside the purview of the United States. In other words, there's no sanction or confiscation that they can impose on me. That's why gold is in this primary bull market.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for June 9th through June 16th, 2025, while supplies last. First this week, we feature 1 ounce silver maples at just $3.09 over spot. Next, backdated 1/10 ounce gold maples at just $39.99 over melt. And right now, for the lowest price we've seen in years, 90% junk silver is just $1 over spot. And finally, 1 ounce platinum Britannia are just $79 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always delighted to have this returning guest. Michael Pento, an active money manager at Pento Portfolio Strategies, joins us this Friday, June 13, 2025. Michael, thank you for coming back on Liberty and Finance.
Always good to see you, Donegan.
I always anticipate your midweek reality checks, or midweek sanity checks, I like to call them, that come out. If you could share with us what you're watching and what you're observing at this time, our viewers are very interested in knowing what direction you see things are going.
Well, I was just muting CNBS because they told you the labor market is strong, and the market rallied last Friday because the jobs number was better than expected. And I guess it was better than expected. It's about 40,000 jobs less than the average of 2024, but it was better than expected. So I guess you should all run off and get over ebullient about the stock market, which is trading at over 200% of GDP once again. So the labor market is cracking, and I want to just finish that. Just wrap up that thought. I just want to also mention that the household survey. So there's two surveys. There's an establishment survey and a household survey. Well, the establishment survey beat the number by a little bit, as I just mentioned. But the household survey showed that there was almost 700,000 jobs lost in the May jobs report. And the labor force shrank by almost 700,000. And the number of continuing jobless claims is the highest level now since November of 2021. So the economy is slowing, liquidity is draining, the labor market is fracturing, but at the same token, there's an awful lot of optimism about the fact that the level of tariffs went from 145% on China to 30%. And there's an awful lot amount of optimism about this extension of the Tax Cut and Jobs Act. So there's a lot of optimism, but underneath, the foundation is fracturing. So I am, to wrap this thought up, you asked me, I'll tell you, I am remain net long the stock market in the correct sectors, which include precious metals. But I am more vigilant now than I've been for a very long time as to when this model that I created is going to signal for me to get more defensive, because it can't be much longer.
We keep seeing notices come out about terminations at the federal employee, from the employee ranks of the federal government. And I think we talked with you last time that the area around Washington, D.C., Fairfax County, Virginia, and surrounding has typically been considered the area that never sees a recession from a real estate standpoint. But I think things may be different at this time. Any insights from you on that trend across the country in different areas, or part of a larger trend of the market?
Yeah, well, the larger trend is that the labor force is shrinking. So you have deportations. I think Trump just got authorization to remove 500,000 people from the United States. And the border is for the most part, closed. So on a rate of change basis, the demographics are all upside down now, which listen, I'm all for controlling the border. I'm just saying that the labor force growth is one half of the input to GDP. So you have productivity growth and you have labor force growth. Well, the labor force isn't growing, it's shrinking. I don't know much about DC. I have a niece that got laid off of her job. She worked for the government. Do you know that the calculation was that there was 70% of all Biden employees, all of Biden's employment, 70%, 70, were government-related jobs, either directly working for the government or contractors to the government. So that's over with. That's gone. So yeah, that's why we're seeing a lot of stress on the consumer. Not only the fact that the labor force isn't growing, but we look at the pressures on inflation. You know, the tariff level is going to be, even if it stays where it is, doesn't go any higher, doesn't go any lower. Trump says, and Besson says, and Lutnick says that the tariffs aren't going away completely because they love that revenue that's coming in. So it's going to be 6 times higher than it was in last year. The level of tariffs 6 times higher. And then you add on top of the fact that inflation is just not going anywhere near 2%. So I'm talking about, here's the truth. I've said it before in this program, and I have to say it as succinctly as I possibly can. The level of inflation has destroyed the middle class of this country and down. And the fact that inflation is only growing at 2.4% now, it's growing at a rate that's above where they can sustain their standard of living. And it's also growing at a rate that's higher than the Fed's target of 2%. And the fact that we just have oil shot up by 8% this morning is not going to help the calculation. So tariffs have yet to kick in. That's going to add to a price shock. I don't consider it inflation. It's a price level increase. And then you have the energy increase on top of that. So not going to get any relief anytime in the near future. And you add on top of that the fact that the Fed absolutely cannot lower interest rates at this point. Cannot lower interest rates because even though they would like to do it, and I think they will do it, especially when Powell gets replaced in 2026 by some version of Al Capone. Right now, the Fed is holding their ground because the inflation is not down to their target level. And there's a reason to believe it could be headed even slightly higher than it is right now, for what I just mentioned.
Even when you mention in the same sentence, I have to ask you, when they say their target level, there's 2 big parts to that. One is we spoke with Dr. Judy Shelton, former advisor to the President Trump in his first term, that in her view and that of, other previous Fed chairs, that the target really should be 0 if you're going to have stable price mandate. But secondly, that even saying their target, the numbers that they're presenting us are cooked books. They're not even accurately reflecting what real people are experiencing. Can you address both of those?
Yeah. Well, in 2000 and in 1913, when you formed this creature called the Federal Reserve, one of their mandates supposedly was for stable prices. That's what Congress has given them, the edict of stable prices. Now, I consider stable 0. I consider stable prices not going up or going down. So that's the definition of stable. But somehow that got under Ben Bernanke and in the zeitgeist of today, every central banker on the planet in the developed world says, yeah, 2% sounds like a good number to me. Even though we're not going to meet that number for 6 years. We're going to be above that number for 6 years. 2% is the new definition of stable. And the reason is clear because they just can't let asset prices fall because that's the assets that banks own. They own, mortgage related debt for the most part. And if home prices fall, banks are going to become insolvent, run on banks, and then they stop lending and the economy crumbles. So they need to get stock prices growing. They need home prices growing. And they think that's going to lead to nirvana. But on the funny thing happened to, Bernanke was a 2007 phenomenon, right, Donegan? So on the way to 2%, home prices didn't go up by 2%. They went up by 20%. And now no one could afford a house. So but the first-time home buyers have been priced out of the market. And so if you can't get the first home buyer in there, then the second home buyer can't sell. And then, you have a frozen house. The transaction market is now frozen. So this is what happens when you morph from stable prices and sound money, which is a gold standard, you limit the base money supply to 2%, which is commensurate with the mine supply, about commensurate with the mine supply of gold, then you just eliminate all these bubbles. And by the way, stop bailing out banks. Let the, there could be a fractional reserve system, which is horrific in of itself. But when you have a fractional reserve system and one of these banks goes amok and lends much more than they have in assets, and liquidity runs dry, do not bail them out. Let them fail. And then we will not have any more inflation in this country. And we'll have a solvent and viable middle class, which is absolutely essential to a healthy country.
But it doesn't sound like a healthy middle class or a healthy country is necessarily what's on the actionable, mandate of or the actual goals of the Fed. In fact, is it not true that the Fed is the banker's bank and is made up of member banks? So when you say let the banks fail, is that just a pipe dream?
It is a pipe dream. In fact, that's why they have something called the standing repo facility. We always had something called the discount window. So even in 1913, if you're a distressed bank, you can take your assets, which were always treasuries, and take them to the discount window, get a haircut on those treasuries, a discount on those treasuries, and you get a temporary loan. But now forget about the discount window. Now we have the standing repo facility, which means if you have bad corporate debt, if you have a bad mortgage-backed security, a CLO, or whatever your investment instrument is that's going bad, doesn't have to be treasuries. We'll just take it off your balance sheet for you and give you some credit, keep you afloat. So I mean, this is the failure of a democratic republic. It's a failure of a free market capitalist system that we have. It's just emblematic of it.
And you say it's a failure of a free market capitalist system. This is not a free market. That's why they're trying to manage it, right? Isn't that one of the points?
This is the abrogation of the free market capital system. I see. That's why we're talking about things like why would this love affair with digital currencies, which is, I think, the precursor just to pave the way for central bank digital currency, where right now, if let's say you have your bank at Wells Fargo. And all these banks say, the Fed says, the central bank says, we are now going to charge you a negative interest rate on your deposits. And then we'll make it 5%, negative 5%. What would you do? Well, you would run to your bank at Wells Fargo and you would say, okay, I want all my money out. I'm taking my physical currency out and I'm stuffing it under my mattress because I don't want to lose 5% per annum. Thank you very much. Well, in a central bank digital currency, they have plenary control of your life. They see everything you buy, everything they sell. There's no more tax cheats, and I don't espouse tax cheating, but there's no more hiding. There's no underground economy. It's just that your money is in the bank, and they thank you very much. Negative 5%, we'll take it. Or if you don't like it, you could take your money out of the bank. No longer. You could only spend it. So you can't hoard money. So there's no more runs on the bank. In other words, it's complete and total control of your life. That is where we're heading. And that's why I think these digital currencies are paving the way. You're going to have a central bank digital currency, a Fed coin, whatever it is. And everybody's going to be happy about it. Oh yeah, wow. And electronic money, what do you do? We have to worry about, making sure all the bills in your wallet are folded nicely and are all, in ascending order, like an obsessive compulsive person like me. Hey, you can't do that. There's no more digital there's no more paper money. Digital coins, currencies have replaced all paper money.
And I know what you mean when you say there's no runs on the bank, meaning people can't withdraw currency in a physical manifestation from that system. That's a concern.
You can move it from one place to the other, one bank to the other. That's all.
Or own real things. That's what you were saying, is people the only option left is to spend it. Ludwig von Mises talked about the crack up boom where people finally grasp, and Alistair MacLeod says that it's always the residents, the citizens of the country itself that are the last to acknowledge the failing of their own currency. It's the foreigners all perceive it earlier. So they finally, when the people living within a country finally wake up to the fact that their currency is going down the drain and going down faster, there's a rush to go spend it. It looks like economic activity. It looks like, oh boy, what a healthy economy we're having, as people are giving up the last vestiges of hope that they had in the stability, financial or monetary stability of their country, or any sense of privacy or control. Doesn't that likely lead to people buying other things that retain value and then trying to barter or sell between each other that way rather than living within the system? Or do you foresee basically a capitulation on the masses of people just saying, yep, I guess we're just going to be within this controlled system after a certain point?
Have you noticed what platinum is doing lately?
Yeah. No, I was going to ask you about it. In fact, that's one of the questions we have for
Gold,
we were asking you to talk about platinum.
yeah, well, I mean, I purchased it from me and my clients several weeks ago. So platinum is breaking out. It's actually more rare or rarer than gold is. It's less prone to oxidation. Gold doesn't really oxidize at all, but it's even, more noble metal than that. And it's less than half the price of gold. So there's a lot of catch up to do there. I'm not saying gold's going down. I think I own both. I haven't sold gold, but I think it's a wonderful investment. But people are, the whole Bitcoin phenomenon, even though it's just so antithetical to what Bitcoin was supposed to be. But the reason why it's so popular is because people are dying for another alternative to the US dollar. And not only the dollar, I mean, definitely it's not, not that they're finding solace in the euro or the yen or the renminbi. So they're looking for places to park their money. Of course, I think it's a height of hypocrisy to say, well, a Bitcoin has its value because it's decentralized, and yet Wall Street embraces it. And then, everybody knows who you are when you buy a Bitcoin ETF because of KYC and AML laws. They all know you are. They can confiscate your Bitcoin, your supposed holding. But you need Wall Street to justify a value that's, I think it's like $106,000 a unit. A unit of what, Dunnigan? Do you know what a private key is, right? It's just a bunch of numbers and letters, electronic numbers and letters. You could write those down on a piece of paper if that makes you feel more valuable about it. That's all you have. That's what Bitcoin is. It's a private key that allows you access to a public key that gets you to a decentralized ledger. The blockchain is a wonderful technology. As to how anybody thinks that can replace or supplant a precious metal is beyond me, because there's an unlimited number of blockchains that can be created. So anyway, I digress. But the reason, the idea, the purest idea of Bitcoin is a way of getting yourself out of the fiat currency system. And so some people are running to that, cryptocurrencies. I'll run to platinum and gold.
I have to shout out.
Maybe even a little silver. I haven't gone there yet, but it's on my radar.
Well, that answers two questions. One, I have to give a shout out to Eric Red Carboni, who asks, what does Michael think of getting in on platinum ETFs? The second was about the gold to silver ratio and what your thoughts were about that. The Nivikados asks, what is your weighting of gold to silver ratio you're holding? I think that's what you just talked to us about. What is it about silver that has your eye?
Well, it's just what you joked about. It's just a reach to get out of the fiat currency system while there's still, this is a very unusual situation where you had stress in the market. And usually when you have a fear of recession and the market starts to fall, what do people usually do? They usually buy a treasury, which is denominated in dollars. So dollars tends to rise. It's part of, if you look at the four horsemen of the economic apocalypse, which I would usually gravitate to in times of recession, depression, or when there's a market crash, well, one of those things is the dollar. Well, the dollar has been performing terribly in times of stress, and that's a huge red flag for me. That tells me that faith in our sovereign bond market is faltering. And if foreigners no longer have the desire to hold our bonds because of insolvency or because of inflation or just because there's no more trade surplus to recycle into dollars, that's a big warning sign. So when the problem isn't, or I say the solution isn't to own dollars and bonds, that's part of the problem. If you don't have a viable plan, you can be in a big world of hurt as far as your retirement is concerned.
That's a very...
So now there's only a three-legged horseman, Don.
This is so key because the vast majority of late career stage and retirement age people and their insurance companies and their pension plans, etc., have been and maybe continue to be banking on bonds as their most stable leg in their asset inventory. Can you please restate what you just said? Because
So it's become a risk asset. It's trading like a pink sheet stock. It being, and I'll be very specific, long duration treasury bonds. Okay. Now I'm not talking about bills. All right. Not even 1 to 3 year treasuries. They're very short end. That's what the Fed controls. And I think they're going to panic soon in 2026. Like I said, bring it back to what we were talking about the labor market. The labor market is clearly fracturing right now. There's not much they can do about it now, but I think next year, especially when Trump replaces Powell with some version of Al Capone, the short-term rates are going lower. But when the Fed cut rates 100 basis points not too long ago, do you remember when they cut rates 100 basis points faster than they ever had? Yeah. What happened to long-term bonds? They went down and yield went up. Okay, price went down, yield went up. And I think the same thing's going to happen next time. So if you're someone who's a pension plan or hedge fund and you think you've grabbed a lot of solace or ballast or an offsetting function by grabbing long duration treasuries, you might be in for a shock. That might be the cause of your issue. That might be the nucleus of your problem going forward. I mean, I just did a deep synopsis of our debt situation. As a matter of fact, I was actually on the phone with a U.S. senator's office who does not want to be mentioned, and I did a long dissertation on the state of our sovereign bond market. We could very well have $67 trillion of outstanding debts. Currently 37. We're another 30 trillion added in the next decade. $30 trillion. Now, I don't know if I said this on your program before, but if I did, it bears reiterating that it took 250 years to accumulate $37 trillion in debt. And we're going to do 30 trillion in 10 years. So the problem now, the nucleus of the next crisis is going to be, as it almost always is a problem in the credit markets. And in particular, is going to be not maybe mortgage-backed securities, although housing is is in not great shape. It might very well be long duration treasury bonds.
We have a question here from a viewer because, as you mentioned, people who have been using long-term bonds as a hedge or as a risk reduction asset are now going to be sorely disappointed going forward, in your view. There's a question here about the rest of the world and what they're doing to reduce their risk. And in the face of geopolitical strife and in the face of American monetary mismanagement, what impact, for example, the war in Iran will have on the price of gold if the war continues into July?
Well, look what's happening with gold today. I mean, I think gold was up about over 1%. And notice that you didn't get any ballast from silver. It's gold. That's why I favor gold over silver. Gold is money. Silver has an industrial component to it. So does platinum too, by the way. But platinum is just soaring, right? I mean, it was overdue for a correction. So, not that I'm giving it advice to you or your listeners, but if you don't have any platinum, today would be a wonderful time, if you're suitable for it, to take some platinum into your portfolio. But the salient question is, what's going to happen with inflation when oil prices spike by 8%, and then you have tariffs on top of that? It's very difficult to believe that the rate of change of inflation, if you look at inflation right now, it was coming down very, very slightly, very slowly and very slightly on a rate of change basis. But not again, that doesn't mean price. I have to be very specific. Prices aren't falling. The pace of increase is slowing. That's a huge difference. But I think the tariffs have yet to kick in, and now this increase in energy has yet to kick in. So I would be hard pressed to believe we get anywhere near the Fed's target. And I always hasten to add, and you can bleep this out, asinine, because this is an asinine target of 2%. I don't think that's going to be hit anytime in the near future.
Again, related to what the rest of the world is doing versus what the U.S. is doing, Bill M. from Florida asks, will capital start moving east at faster rates as the dollar crumbles, U.S. cities burn, and Europe fights wars, in addition to the monetary destruction that you just described?
I think it's much more important. I don't think anybody's going to trust the renminbi over the dollar. It's a function of saying, I'm China, and I have or Vietnam or any trade surplus creditor nation. They all they have to say is this: I no longer want to park my savings in dollars and U.S. debt. I prefer to own gold, or in some cases in platinum and silver. I want hard assets. I want to hold these assets that are outside the purview of the United States. No, in other words, there's no sanction or confiscation that they can impose on me. That's why gold is in this primary bull market, in my opinion.
More viewers' questions along these lines. It says, Felix the Cat 69 says, Michael, you seem to have been positioned for a market or a financial crash potential for some time, and returns therefore missed out on some of the upside. Wouldn't it be better to keep a little dry powder, stay long, and buy cheap insurance to protect against a market crash?
Well, anybody can get access to my returns, so they're published. They're openly published. So no, I'm not. If your benchmark is the S&P 500, sometimes I beat it and sometimes I don't. But I'm net long the stock market. I'm almost 25% net long stocks. I have foreign stocks. I've got precious metals. I have momentum. So I am long and I am up on the year. So the question premise is incorrect. In fact, I think I am beating the S&P 500. So I don't agree with the tenor of the question. My model will tell me when to get less upbeat. Listen, and people, and I get this question a lot over the years. I've been in the public eye since 2005. So when CNBC needed a buffoon, there was like a straw man to knock down, like someone who was negative on the housing market. So they used to make fun of me and they laugh. I used to debate Art Laffer and everybody was a permeable. Here's what I've been permanently bearish on, not stocks. I'm permanently bearish on the foundation of the way this country's been run since the year 2000. I'm bearish on printing money. I'm bearish on inflation. In other words, using inflation as a way of floating assets to protect banks. I'm bearish on our debt and deficits and our current account deficit. Those are things I have been bearish on. So if I sound like I'm bearish, I'm saying I'm bearish on the fundamental foundation, the way this country has been operated on. I'm also bearish on the way Japan and Europe and China are operating too. And so it's not just unique to the United States. But to say that I've always been bearish on the stock market is just incorrect. I wouldn't have a business if I didn't provide a pretty steady return for my clients. So I have a model. It's based on the second derivative, or the rate of change of inflation in the context of growth. So I know when to own bonds or when to short bonds, what currencies to own, what commodities to own, and what equities to own. That's how I manage money.
We've talked about strategic relocation in the past. You and I have both made moves to Florida in this past decade, and both finding a lot of reasons for validation that was a good move for us. This is a question also from Bill M. from Florida. Michael, you miss New Jersey?
Well, I go up there I still have a home in New Jersey, so I go up there often. So I miss family. I think New Jersey is wonderful. Parts of it in the summertime, just don't go, just close your eyes on the way to Newark Airport. And when you go through Linden and Elizabeth, you'll wonder how it got the moniker Garden State. But now I miss family, but I don't really miss this. Listen, this is a beautiful state to live in, and wonderful people. So.
And this one is, I want to ask you how people can take advantage of your services as an active money manager. And along the way, Cola V1 says, please, can you start providing an international service? So you'll let us know what your main line is and whether there's an option for people who are not U.S. citizens.
So if you're not a U.S. citizen, I have a service that I don't manage your money, but I'll give you alerts as to when I make changes in the portfolio. It's called the real-time reality alert. It's not anywhere near as good as being a U.S. citizen. I make the changes for you in real time. So the other service is delayed and only available to international investors. So, but if you want to know more about how I manage money, it's pentoport.com is the website. You'll see on there a midweek reality check, which is a podcast I record every Wednesday evening. It gives you the actual data that you need to pay attention to. So in other words, you don't hear the non-farm payroll report in May and say, "Oh wow, the labor market's strong," which I couldn't believe. I kept on hearing that, and when I dug through the numbers, I was like, "Wow, this is something for my podcast. I got to tell people that the household survey showed a loss of like 696,000 people." I mean, why wasn't that made much noise as the other stuff, and the shrinking labor force and the multi-year high and continuing claims? So that gives you a 36,000 foot idea of what data I'm looking at and some general ideas of what I'm investing in. It's only $50 a year, so it's a really it's money well spent.
We've been speaking with Michael Pento, active money manager at pentoport.com. Michael, I'm grateful. I always learn from our discussions, and I know our viewers do as well. Thank you for joining us again here on Liberty and Finance.
I look forward to it all the time, W.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for June 9th through June 16th, 2025, while supplies last. First this week, we feature 1-ounce silver maples at just $3.09 over spot. Next, backdated 1/10-ounce gold maples at just $39.99 over melt. And right now, for the lowest price we've seen in years, 90% junk silver is just $1 over spot. And finally, 1-ounce platinum Britannia are just $79 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.